Hey, good morning, everyone. Marty Missouri here, July 20th, 2022, Wednesday, with your midweek technical stock market snapshot. We'll do the usual. We'll look at the 60-minute, daily, weekly, and monthly timeframes for the S&P 500. Then I want to close by jumping over to that signal on the NASDAQ Composite Index weekly chart that we identified here a few weeks ago and see how that's faring. So jumping right in with the 60-minute S&P chart. So recall that, we were eyeballing this consolidation pattern in here. And while I've been skeptical, I have to admit, I was saying, you could make a case that there's some upside from here. Expect some serious resistance at that 4,000 level, which we're getting close to. If we break through above that with some strong momentum, then I think you could see some what's called gamma hedging among options dealers who have sold calls in that area that could exacerbate the upside even further. Not all that different than the dynamics underneath yesterday's rally that I talked about on this morning's written blog. Yesterday, going in, it appeared that we had just massive short interest. And when you get that kind of a move that's going away from those shorts, they're going to have to cover. So I think yesterday was largely short covering rally. And as I mentioned on the written blog, there were dynamics around VIX options expirations that were happening this morning that consultants of ours suggested could be bullish for yesterday's session. So as I summed it up on the written blog yesterday, it was more about positioning than fundamentals. However, you have to be cognizant of the fact that, when you're in a deep sell-off and the market begins to bottom from there, certainly we're going to be talking short covering rallies, at least to get the thing going. So while we're still doubtful that the ultimate bottom is in, as I say over and over again, we remain open to all possibilities. And as I pointed out recently on the blog, some of the real bearish narrative around the bullwhip effect and what that ultimately means has to be really called into question when we look at the health of the consumer, what they're actually doing as opposed to what they're saying. And then we can talk about positioning in the market, huge cash on mutual fund balance sheets like we haven't seen in a long, long time. Lends itself to kind of bottomy sort of conditions that I think we need to, continue to pay attention to. So as for the technicals, again, so we broke out of that pattern with some momentum. And you can see this morning, you still have a pretty solid buy signal here on the MACD. If it were to roll over right about there, that would be a very bearish divergence against this. So, the bulls don't want to see that. On the hourly, a little oversold right there. So again, I've yet to see a setup like we saw back here where we got extremely bullish for a short period of time and somewhat bullish back in here. Wasn't able to go there here, but was acknowledging that, there's a setup here that could, given the right news, the right earnings reports and so forth, could be special, at least for a short-term rally, and that's what we're getting. Looking at the one-year daily chart, which is where we were more constructive, but again, still, I got to admit, still skeptical. This is a nice look right here, at least in terms of breaking above that trend line, and as of yesterday, recapturing the 50-day moving average. For a lot of technicians, that's got to be a very big deal. And then this morning coming back and bouncing off of that a little bit, right? But still holding above, at least as I speak at the moment, I would say that that's special. And, that lends itself potentially to this thing gaining a little steam to the upside. Now, having said that, nothing in the world worse than a failed breakout. So if we fail here because of some poor earnings news or some robust economic news that would have people thinking, uh-oh, the Fed may get even more aggressive. We've seen the opposite of that, and I think that's helping this morning, looking at some of the data that's come out. So got to be open to all possibilities here. Remember these gap analyses. I said that we will absolutely fill this gap, and we will absolutely fill this gap too. My best guess is that 4,000 is going to offer up some pretty stiff resistance. Looking at the underneath options action, apparently yesterday, a lot of hedgers and bears were just buying more and more put exposure as the market continued to melt up. We'll know later kind of how the complexion of today looks with regard to that, but really interesting to see. how things continue to set up very short term as we push up against that 4,000 mark. Also keep in mind, folks, the better this market looks leading into next week's Fed meeting, the more they'll be willing to sound hawkish in their commentary and Powell during the press conference. If the market were to bump up at that against that and roll over hard, I do think that would have them not changing their 75 basis point increase, which is what pretty much is dialed in, but maybe changing the language a little bit. I am not in that camp that says the Fed wants to kill the stock market or create a really bad recession to beat inflation. I'm just not there. That would be a tiger changing its stripes. And I get that they can, and I get that they may very well be there. I think that tiger will realize that those stripes are the same itself when it's ultimately facing something deep to the downside. So I do think there's a Fed put, so to speak, and however that gets expressed, it's not at these levels. And the better the stock market does, that actually is an ease on financial conditions. That does essentially go against what they are truly trying to create right here, which is tighter financial conditions. And a rising stock market is not disinflationary, right? So be careful what you ask for, because this rally just continues to gain steam. Then suddenly the odds of the Fed kind of upsetting the short-term apple cart grow. If the market tanks, then I think the odds are less so, and they might offer up language that kind of keeps things more on a, for lack of a better term, somewhat even keel. As for what, technically speaking, is kind of driven that 3,500 target for us, that's found in the weekly and the monthly charts. So remember, we analyzed this back 3 decades or so, found similar patterns outside of recession and so forth. And boy, the 200-week moving average was just a solid floor for the market when it was trading like it is here currently. And when I draw this trend line out, I have this occurring perhaps in the fall. Coming above that trend line on the weekly, and if we can get a weekly close above that, that's a bullish look. There's just no ifs, ands, or buts about it. And then, as I pointed out recently on the momentum indicators, they're starting to see some signs of life. We have this this histogram telling us that we're getting pretty close to a buy signal on the weekly chart as well. Now, by the way, if it's the moving average, the level is moving up here, right? So not 3,500 on the weekly, call it 3,525. And then the most compelling of the charts is the monthly. It's that monthly MACD sell signal, bearish divergence on the RSI, taking you back 30 years without exception. Outside of recessions, you bounce off of the 50-month moving average, and that's moving up a little bit here, so call it 3480. You split the difference between the two and you come up with a 3,500 price target. And there's nothing really encouraging for the bulls here. You still have this downtrend line, really strong sell signal, nothing here on the monthly that says, like on the weekly, that maybe things are beginning to turn. And of course, the monthly is slower moving. So yeah, from a long-term technical perspective, still makes a lot of sense to us that this market has a bit further down to go before it ultimately bottoms. And then the overall macro conditions, the economy, recession, no recession, that's also going to play into our thesis as we get closer to these levels. Okay, and then lastly for today, that NASDAQ weekly chart. Remember, we identified back in here for the last 30 years that when you had a weekly oversold read on the RSI, which is not all that common, as you can see, you got some huge rallies. Back here during the tech bubble burst, this was like an 85% decline in the NASDAQ, right? Well, along the way, you had these massive 40% rallies twice while it was melting down. Okay, and they came off of oversold levels, and then it was oversold right at the bottom, and then you kind of left everything behind. Here in 2006, you got oversold, 27% bounce. During the financial crisis, several bounces. I think the worst performance was like 14%, maybe it was just 18%. I know it's all jumbled up in here. You had it here in 2018, you got a 30% bounce, and then off of COVID, you got, call it an 82% bounce before it got back to overbought conditions. So zooming in, we had it here, oversold, went up 12%. So this now would be the worst rally, 12%. in the last 30 years off of this signal. Why? Because we got oversold again right here. It did get below 30. So far, that one is up, if you can read that, call it 13%, 12.8%, and looking pretty good, right here, just looking at the price action. And by the way, that's a buy signal on the weekly NASDAQ composite chart. So yeah, you could look at this and start getting pretty bullish about the the overall state of affairs. And one thing we did do here recently is we did add to our technology allocation here as we rotated a little bit here recently. So again, folks, even though we think there's lower lows to be had, we do think there's opportunities along the way. The challenge for us is to stay effectively hedged because, as you know, the world is a very uncertain place right now. And an event or a series of events could, recreate something really, really ugly. So we definitely need to be aware of those kinds of risks and protect against, hopefully the lion's share of those declines. But we don't want to just be wedded to that potential. We do want to continue to assess conditions with an open mind and recognize where there are bullish developments like we're beginning to see here on these charts, and to some degree in the overall economic backdrop, as I've explained. I'll leave it there for today, folks. Be back with another video, probably attach it as usual to our economic update. And hope you have a great rest of the week. Talk to you soon. Bye-bye.